if you want an education on how to raise private capital, about how to do syndications, about how to buy multifamily assets, larger multifamily assets, and even other asset classes, leveraging other people's money in addition to bank financing, but to put together deals and build a business that's going to be extremely profitable, she's got the roadmap for it. Stay tuned. Hey, welcome listeners today. I have the distinct honor and privilege of having Kim Lisa Taylor on our show. She is a nationally recognized corporate securities attorney, speaker, and the author of the #1 Amazon bestselling book, How to Legally Raise Private Money. She's the founder of Syndication Attorneys and multiple other companies around that. And their purpose is collectively to provide quality legal advice, plain English offering documents, professionally designed marketing materials, and education for clients who are raising money in real estate, startups, or growing companies. She's been the responsible attorney for hundreds of security offerings and is listed in the 2020 top 100 attorneys and top 100 in finance magazines. And Kim is out of Florida, but she represents clients nationwide. So Kim, welcome to the show today.
Well, thanks, Paul, for having me. I'm really glad to be here.
Yeah, absolutely. Absolutely. So just to kind of start off at the basic level, as we were discussing before I hit record, a lot of our listeners and clients are entrepreneurs, business owners. They have growing businesses. They're creating a lot of cash. A lot of them are buying commercial real estate in terms of where they operate their business from. And in addition to that, a single family, multifamily, and many of them are looking to grow in both their business expansion and also their real estate track and that portfolio, because they understand the advantages of that and part of their wealth plan. And you bring something to the table that I get asked about a lot in terms of, hey, Paul, can you help me deploy some of my own money? Can you help us put together a group or whatnot? And so your expertise is deep there. And so if you could spend some time today, and I've got questions, but just this concept of, how does someone go from there to this syndication? What is it? How do you raise capital for it? And that sort of thing.
Paul, thanks a lot for having me on. Where we get involved mostly with real estate investors that are just starting out is, a lot of people will start out in the single family space because that's what we're all comfortable with. We can understand buying the house next door and renting it out. And so a lot of times you can finance those properties with private lenders, people that might loan you money, or hard money lenders. If you go to your local real estate investment associations, you can meet a lot of hard money lenders that's happy to loan you money. And usually you'll have to put in a little bit of your own money because they might not. Sometimes they'll loan 100% of what you need, but sometimes they'll only loan a portion of it. And so you've got to put in the rest. But then you quickly realize that if you might not be making enough income to support the lifestyle that you envision or to achieve whatever your real estate goal is. So you figure out that you've got to scale up, do more properties, which you don't have the money for on your own, or you start having friends and family seeing your success and they want to participate and you want to be able to help them. So in both of those cases, what you end up doing is exploring, how can I bring investors into my deal? And that's where we come in. We work with a lot of first-time people who have never pulled money from private investors before. And we've made it our mission to not only just provide the legal documents that you need and the legal compliance part, but we also want to educate you on why it's important, what you need to learn, kind of putting all the pieces together so that you gain a comfort level and confidence to be able to go out and do it. Because the first thing you're going to learn when you're trying to put a deal together with investors is that there's securities laws that apply to what you're doing, and that sounds daunting and scary. It's not. I liken it to learning to drive a car, right? You've got to learn how to operate the vehicle. You got to learn the road signs, and you got to learn how to navigate to get from here to there. So once you've kind of learned the parts of syndication, you can put it all together very easily, and it becomes as comfortable as what you do right now. When you first went to driver's training, it sounded scary. Once you learned all those pieces, now you just grab your keys and go get in the car. You don't give it a second thought. You just do it. You know what to do. So, there's basically three parts to syndicating. There's one is the securities compliance. What does that mean? How do we figure it out? The other is how do you structure your deals with investors, and how do you fairly split money with them? All right, what's fair for you to earn? What's fair to offer them? And how do you figure out who contributes what? So that, and that was a big mystery for me when I first started in this industry also. And then the third thing is how to go out and meet and develop relationships with investors that will actually invest with you. And we always presume that our clients are coming to us with knowledge of the real estate that they want to buy. So they either got other coaches or, they've had the experience to understand this is what we're buying and this is how we can make it profitable. The only, missing piece for them is how do we incorporate our investor pool into that? So that's what we do.
Got it. So what you're saying basically, just to kind of recap a little bit. So number one, if this is a space that you're interested in getting into, you have to understand that there are security laws and regulations you have to follow. You can't just go out and run an ad. Well, we used to say run an ad in the paper, right? But I guess you would do it online, or I don't know how you would do it today. But there are laws and there's a roadmap you have to follow. But there's no reason to be intimidated by that. It's just a process that, when properly guided by someone like yourself who understands it, once you learn it, then it's not that big of a deal. And then the other two pieces are how do we structure the deals, which to me makes total sense, because it has to be profitable for not only you and the investors, because why would someone risk their capital, right? In the deal. And then the last is meeting investors. And what you're saying is that you're sort of under the presumption that when someone comes to you, they understand the property piece and sort of the bigger picture on how they're sort of their end game, how they're going to make profit on it, but they don't have the money to execute the transaction.
That's exactly right. Yeah. Most of our clients have come after they've attended some training program, or they've had a mentor that's taught them how to buy the real estate and what real estate they should buy, what real estate to avoid. And they've usually picked an asset class that they're going to go into. So, we have clients that are doing multifamily or self-storage or mobile home parks or RV parks, land flipping, ground up development. It just pretty much any way that you can think of that you might make money on some type of income producing property. Those are the clients that are coming to us, and we're able to help them. And even those that want to continue on to build their single family portfolio, we can help them too. If that's what you've been doing and you're comfortable with that, we've got people that do short-term rental funds or midterm rental funds or long-term rental funds, or fix and flip funds.
I see. So you can use it for a multitude of different asset classes. And if somebody's already comfortable in that space, they know it. They don't necessarily have to go get another mentor or whatnot in a new space. Maybe that potentially could be a place for them to start, because now they're familiar with it. They can start raising their own capital and they can accelerate that, or they could take that next step up to something larger. What are you seeing from your perch, since you see so many deals? Now we're in 2024, right? So the world's changed a lot. The money world's changed, the real estate world's changed. What do you see as some of the most popular or most successful asset classes today? And what do you see as sort of a typical deal size? Are we talking, tens of millions of dollars? Are we talking, 1 to 10? Are we talking under 1? I mean, what kind of things are you seeing that are maybe trending today?
Well, so there's certainly a lot of multifamily investors, and by far that seems to be the most popular thing that people graduate into because we can all relate to it, right? We lived in apartments, or we know somebody that's lived in apartments. We understand that model inherently just by having done it. And so that's a very comfortable place. The problem with multifamily right now is, there's a lot of people out there training people how to buy multifamily. There's a lot of competition for the deals. The interest rates have risen within the last year, and made and the sellers adjusting their prices to meet the interest rates. There's always a lag time,
Hmm.
6-9 months, where they're still trying to get the high price they were 6 or 9 months ago, until they finally realize, hey, I really need to get rid of this property. Then I'm going to have to reduce the price because the cost of capital is higher, right? If somebody now wants to get into it, they're going to have a larger monthly payment, so they have to pay less for the property so that it still makes financial sense and leaves them enough money on their table for them to be able to split the profits with their investors. And so, there's this is a great time to learn some different asset classes. And so we've got a lot of people that are doing self storage. That seems to be a natural progression from, multifamily isn't working for me right now. Maybe I'll try self storage.
Hmm.
So, there's a little bit of competition there also. But, getting creative. I'm actually, working on a book talking about different asset classes that people can invest in, just based on the things that our clients are doing. Mobile home parks, maybe there's not quite as much competition there, RV parks. But in each model that you want to look at, it really behooves you to go out and find somebody who's done that before.
Hmm.
Either to bring them onto your team for your first few deals to help enhance your credibility and teach you the ropes, and also to make it more attractive to a lender, because you're always going to want to get lenders on commercial properties, always, because the bank, believe it or not, even though the interest rates are high, they still want less than private investors want.
Hmm.
So it rarely works on commercial properties for you to finance the whole entire thing, unless you're just, you're going to do land development. You want to just pay cash for the land and the entitlement process. That's okay. And then when you get to the point where you've got to put in some more money to get a construction loan, then you can syndicate at that point. But in all other cases, it really makes a lot of sense when loans are available to get a loan, even if it's a bridge loan. Although, be careful on bridge loans right now, because bridge loans with short maturity dates and adjustable rates that start to happen within 2 or 3 years are very dangerous.
Right.
All in the last recession, the people that really lost out and had significant financial issues with their properties were the ones that had short maturity dates on their loans. So the loans came due. You had to pay off the balloon payment at a time when real estate prices were depressed, and you had no
Mm.
ability to extend that loan or get another one, because perhaps you couldn't get a loan for the same amount you had before. So you either got to bring money to the table in order to get a new loan, or you end up losing the property. So, and also it's a time to don't over leverage your properties. Keep your leverage low on the property. So we see a lot of lenders just naturally doing that right now. There was a time when people would be able to get 80-85% loan to value institutional loans on commercial properties, but now we're seeing a lot of 65-70%.
Mm.
But that's so that means you've got to bring in more money from private investors to make up that difference. And
Yeah.
that's okay. But that'll also help you ride out any dips in the market. Real estate is very, very cyclical. Historically, there's been like an 8-year cycle up, 8-year cycle down, 8-year cycle up. So if you position yourself with lower loan to value ratios, longer maturity dates, maybe 5 to 10 years before you have to pay off that loan balance, and you've got a fixed return in between, then you're going to be in a much better position to ride out those waves. And and eventually the prices do go back up. They go back to up to what they were before, and they even surpass it. But you've got to ride out that wave. You got to be able to hang on and not have that loan come due at that lower value point, or that's where you're going to get in trouble. So we've got people that are looking at all these other asset classes that you can do. And we have a podcast also called Raise Capital Easily, Raise Capital Legally. And I've been interviewing a lot of our clients that have done some of these other asset classes, just to introduce our audience to these other concepts and things you might not have thought of before.
Oh, that's fantastic. I'm going to plug in myself and recommend that. I think I think you're right. The multifamily space, we do a lot of that, and it is a very popular asset class. But there are so many that are just sort of ignored, and people aren't aware of them because they're not talked about sort of writ large, like multifamily, single family. And I like your approach to your thoughts on being conservative and not over leveraging, because real estate is a long play, right? It's not, people talk about and sometimes in the same sentence of get rich quick and retiring and all that. And yeah, sure, you can get rich and you can retire and you can build a profitable business, but any business is a long-term enterprise, right? And real estate investing is one as well. And none of us are um, we don't have a crystal ball. Nobody knows what's going to happen tomorrow. Nobody predicted COVID was going to come, and the treasury markets were going to do what they're going to do and whatnot. And, this year we have an election. Who knows what's going to happen this year, right? There's always surprise. And it always has some kind of impact and collateral impact that we don't know of. But if you take a long perspective, it doesn't have to be 30 years, right? Like you said, 8 years, 8 years, 8 years on a cycle. But if you tread intelligently in, then you're positioned to weather those storms, but also to really build something that's legitimate, that you can look back on 10, 15 years from now and say, wow, we've really done something, pretty cool, right?
And
To
we've
grow into.
seen several of our clients that started out, just never having done this before. One that built his portfolio of 26 multifamily properties over 8 years, and then went on to start syndicating um, assisted living facility developments, and also now investing in hotels. And he's done very, very well for himself. He has a $200 million portfolio now.
Mhm.
We have some other clients that started out buying multifamily $3 to $5 million properties, and now they're buying $30 to $50 million
Mhm.
properties.
Mhm.
And that took a 6, 7 year process. So it's not a get rich quick; it's a get rich slow. But you get rich slow at the same time that you're bringing your investors along with you, because the ones that those two clients as examples, one of them has a database of 550 investors that invest with him again and again. He can
Mhm.
raise $5 or $10 million in a couple of days.
Right.
The others have 300 accredited investors, and they started out with non-accredited investors, and now they can raise, I've seen them raise $10 million in a week. But you asked earlier, what is a typical deal size? So a good, comfortable raise for people who have not brought investors into a deal before is $1 to $2 million.
Okay.
Most of our clients that are just starting out are able to pull that off from their own group of family and friends. But that's predicated by the fact that you've been out telling people for a long time what you're doing and kind of bringing them along on your journey.
Mhm.
Explaining to them how the process works and all the things that you're learning from your mentors, from your coaches, from the training programs that you're investing in, and helping them understand how it can be beneficial for them to come along. And then when you do find something, saying, okay, you've pre-vetted them, you've had conversations with them about their financial situation, whether or not they're even eligible to invest in these deals, and now you can start bringing them into the deals as they arise. And that's really the best thing is you've got to realize you're it's a two-faceted business. One, you're looking for properties all the time and you're submitting letters of intent and trying to get those to stick. And then the other is that you're also cultivating relationships with investors who understand what you're doing, who've been like I said, pre-vetted, and then now they're ready and they're primed to be able to invest with you as soon as you have something. And that could take a 6 month process before you actually find something. So there's a
Mhm.
time investment that goes along with it, and your education investment that is key to learning how to do it, and to set that foundation. And you probably only really need a coach for the first 2 or 3 deals. Some people keep them longer because your coach will keep you on track, and they'll keep you from veering off and going off in the wrong direction. It's very easy to do that. It's very easy to say, well, I can't find any multifamily that works, but hey, here's a ski resort that looks really interesting. And unless you know something about ski resorts and you can bring someone on your team that has that kind of experience, that it's unlikely that you're going to be successful with that investment, either getting it funded at all or actually operating it in a way that's going to be profitable.
So okay, so it's a journey. You're saying the typical kind of first place to start is at 1 to 2 million. Probably going to raise that from friends and family, but you're doing that because while you're being educated and you're in the process of learning and looking for property, you're educating them on what you're doing, and you're sort of sowing the seeds of the field. Like, hey, we're gonna find this property is what's going to do, and getting your team on board. Now you mentioned this word, and I know what it is, but let's just address it. Accredited versus non-accredited and what that means specifically. I know there's Reg D and a lot of things out there, but just again, first level step entry into this syndication space. What do people need to know or understand there?
So let's just kind of back up and do a little very quickie securities primer. So first we have to decide, you start out with maybe promissory notes. Those are securities, but they're usually governed at your state level. And there's, maybe some level at which you can do those without triggering having to comply with disclosure requirements and filings and things like that. That's usually dictated by your state. Then you might go graduate into joint ventures. Joint ventures are, where everyone is actively involved in generating their own profits. So it's a good way to start if you have one or two investors that want to come in with you on a deal, but it doesn't work for more than 5 people. In fact, the fewer the better, because it's just very hard. You have to get everybody to agree on everything. And when you start to get too many people, you can't get people to show up, you can't get people to engage, you can't get them to participate, and you can't take control of their money, because if you do, now you're falling into the realm of securities law. And how that happens is that the Securities Act of 1933 contains a definition of what are securities. And it's about a half page long, and there's a lot of words and phrases in that definition. You can look it up online and see. But the ones that pertain to you specifically are the very first thing in the list are notes. So those promissory notes where you're borrowing money from investors, those do qualify as securities. But the later one that most of our clients are using is something called an investment contract. An investment contract is, the technical definition is an investment of money in a common enterprise with an expectation of profits based solely on the efforts of the promoter. And so translate that into plain English. You're doing all the work. Other people are relying on you to generate the profit. They're passively investing and they're not participating actively in managerial decisions. You're making all the day-to-day decisions. You're deciding what to buy, how to get it financed, how much money you need to raise from investors, how that money is going to be spent. And then you're periodically evaluating the cash that you've generated, and you're splitting it between your investors and your management team. And so that's what we call syndication. So syndication is really just pooling resources from a group in order to achieve a common goal. So the resources on your part could be your education, the time you've invested in your education, learning how to do it, cultivating this list of investors, and all the deals that you've looked at to try to find one that seems viable, and then trying to put all that together into a group that actually gets it to the closing table and then continues to own and operate that property. That's your typical syndication model. Kind of the graduate up from that is a blind pool fund, where you would try to raise the money in advance of having deals under contract, and you're raising the money based on your business plan. It is a harder way to raise money, but for single family fix and flippers, you really probably need to use that model, but you have to do it based on your track record. So if you don't have a good enough track record, you've got to bring people into your management team that have a significant track record doing the same kind of thing that you're offering to investors in a fund. So that's kind of your what is your model? What type of model are you using to bring investors into your deal? So we just covered the promissory notes, joint ventures, syndicates, and then maybe a fund. And each of those is kind of a graduating step. You don't necessarily start directly as a fund, but you could graduate up to that after you've built that track record. The next thing we've got to figure out is what are the securities laws that you have to comply with. So now that we know, if you're selling investment contracts where people are passively investing, so this would apply anytime you're selling interests in a company where there's a management team, and people erroneously call it the GPLP model, like a general partner, a limited partnership, where you have a general partner that does all the work. They're responsible for all acts of the partnership. And then you have limited partners, who are the ones that put up the money but don't participate in management. That was the original syndication model. We've now graduated into limited liability companies because they give better liability protection for the management team. That's primarily the reason, and lenders are more amenable to that. You would really only use a limited partnership if you were bringing people in from outside the country for a variety of reasons. But so the LLC structure is the same. We have a management team. They're called a manager. Asset manager is technically what they're doing. They're managing the company on behalf of investors. They're not the property manager. They're the asset manager that's managing this investment company they've created on behalf of the investors. And then we have the members, and the members can have different classes. So we've usually got a class A, which is all the cash paying investors. So that would include members of the management team that are contributing cash to the deal. They would buy Class A interest right alongside the other investors. And then we have Class B, which is the section that we reserve for the management team for all of their non-capital contributions. So their sweat equity. This is where you're putting in the effort and the time to asset manage this deal and to put it all together. So the way that syndicators or fund managers earn money is in the form of fees. And also in the form of a share of profits between those Class A, Class B members. So it can be pretty lucrative. The fees are really just to keep you going. The fees are always going to be taxed at ordinary income rates. So we're going to minimize the amount of fees that you get. We want to maximize the amount of profit share that you get, because we can structure that in a way that it's taxed more favorably, both for the investors and for you. And so that's typically why we structure them the way we do. But that's a very typical structure, where you'd have a manager managed LLC with a management entity being a separate LLC, just comprising those members of the management team. And then we have Class A members and we have Class B members. And Class B is usually the same people that are in the management entity.
Putting their sweat equity in.
Yeah, so that's so now we're talking corporate structure. So we've talked about the securities laws. So securities laws, now that we know we're selling securities, now we've talked a little bit about how you're going to structure this deal. So what are the securities laws you'd have to follow? Well, when you're raising money from private investors, you're selling these investment contracts, you either have to register the offering in advance of even talking about it to anybody, or you have to qualify for an exemption from registration. And so there are some exemptions for what are called private offerings. The registration process is actually taking your company public. So that's Google did, Facebook did, Tesla did. It's a very long and arduous process. It's very expensive. It's going to take, maybe a year or more to get approved. And it's going to cost a lot of money. Well, you don't have time to do that if you have a commercial property under contract that you need to raise the money within 90 days and get it closed. So the alternative is to qualify for one of these exemptions. So there are exemptions that allow you to raise money from private investors without going through the registration process, but you have to document how you followed the rules. So there's a specific set of rules. We're going to pick which exemption fits your model, and then we're going to have you document how you followed those rules, so that if you ever are questioned by a regulator or maybe an investor's counsel, if somebody wants to get out of a deal or they don't like what you're doing, they want to sue you, then we have to document how all of that occurred to create a defensible position for you. And think of this like a tax deduction, right? So when you're filing your income taxes, you say, hey, I qualify for this tax deduction. But if you were ever questioned by the IRS who wanted to do an audit, then you would have to produce the documentation to prove why you were entitled to that deduction. And if you can't produce that, then they're going to take away the deduction. They're going to say, hey, you owe that tax. You should have paid it. We're going to fine you for not taking it, and we're going to charge you interest for all the time that we should have had the money. So kind of a similar scenario with these securities exemptions. They're self-executing. You're obligated to prove how you followed the exemption and to be able to produce that paperwork demonstrating that you did comply if you were ever questioned about it. And as long as you do it correctly and you know what you're doing, because you've taken the time to learn it, then you're going to be okay. You're going to have that documentation, and you're going to be able to produce it, and it protects you. The documentation actually protects you, because one of the things when you're selling in securities, you have an obligation to give the investors all of the information they need to make informed consent. And that's information about the property, information about the real estate market in general, information about you and your management team, whether it's good, bad, or ugly. For instance, somebody has declared bankruptcy within the recent past, then that could affect your ability to get a loan, but it also might affect an investor's decision to invest. Maybe they don't want to invest with somebody who declared bankruptcy. A lot of times you can just explain, hey, I had a divorce and this happened and it was unrelated to my business, and then they understand. Maybe they've seen that situation before or been in it, but they need to know. You need anything that's about you or the deal that could have altered their decision to invest. You want to make sure that you told them that up front. And the way we do that is that there's a very specific set of documents called an offering package, a securities offering package. And so one of those documents is a private placement memorandum. Private placement memorandum is the disclosure document that explains to the investors all the different risks of investing in the deal, all the things that could go wrong. If it's a construction project, you're going to talk about construction risks. If somebody could get hurt, a contractor could flake out, the cost of goods could rise, or your supplies could rise, your labor costs could increase, all the different things that we just experienced after COVID, right?
Okay.
We're going to talk about those things. We're going to talk about things. There could be a pandemic and the whole world could get shut down, right? We didn't know that before, but now we talk about it, right? So we talk about the fact there could be a financial meltdown in the markets, and if that happens, then we get caught in it. So if we tell the investors all those things that could possibly go wrong, and we try to imagine all the scenarios, they then fill out a subscription agreement that explains that they meet the qualifications for that specific exemption, that they're going to invest anyway. They read all the risks in the PPM, then they want to invest. So then you asked earlier, well, where do these definitions of accredited and non-accredited investors come in? So these exemptions that we're talking about have some financial qualifications that go along with them. So a very popular exemption that everybody uses is Regulation D, Rule 506, and there's a Rule 506B and a Rule 506C. So Rule 506B is a rule that allows you to raise an unlimited amount of money from an unlimited number of accredited investors and up to 35 non-accredited but sophisticated investors. But you cannot find them through any means of general advertising or solicitation. And the way to prove that is to be able to demonstrate that you had a pre-existing substantive relationship with every investor before you invited them to invest with you or told them about the deal. So you can talk to them in general about what your company does, but when you get a deal, you have to have that pre-existing substantive relationship already in place. And that means you've pre-vetted those investors. You've talked to them about their financial situation. Are they accredited? Are they sophisticated? So accredited, this is an evolving definition. In fact, Congress just recently met to discuss it on March 5th, trying to determine whether or not we should be making some changes to this definition. But as it stands right now, an accredited person is someone who has over $1 million net worth, excluding any equity in their primary residence, or they have $200,000 a year income if they're single, or $300,000 if they're a cohabitating couple. So they don't have to be married, but they have to share the same address. So that's the definition for individuals. There's 9 other definitions. One of them is a knowledgeable employee. Also, the members of the management team of your syndicate are, by definition, considered accredited for the purposes of investing in your own deal. So, this is the most common exemption that people use, 506B. It allows you, again, to bring in your family and friends who might not meet that definition of accredited, but they are sophisticated. So they have to have, by reason of their education, background, investing background, or experience, they have gained enough knowledge to be able to understand the offering documents you're going to provide them, how the deal is structured, how it can be beneficial for them, and to be able to take on those risks. So when you're pre-vetting investors to establish this relationship, then you're going to talk to them about those things. Do you meet this definition? You give them the definition of accredited. Do you meet this? If they say no, okay, well, here's the definition of sophisticated. Do you think you meet that? If they say yes, then you're going to say, can you tell me how? You're going to take notes on that. And then once you have all of that information, you've talked to them about, hey, we do deals that last 5 to 7 years. Does that work for you? We try to find deals that yield returns for our investors in the mid-teens. Is that something that's of interest to you? Once you've had that conversation and you've documented that conversation, now you have the correct pre-existing relationship, substantive relationship, so that you can start offering them any deal that you have after that point. So, you have to do that before you have deals, because it has to be pre-exist and predate the offering. If at the point that you have the offering, anybody you might meet and vet would have to go in a future deal. So that's 506B, and that's the limitation. 506C allows you to include you can freely advertise, but you are restricted to verified accredited investors only. So only those who can prove to a third party that they meet the definition of accredited, and then that third party, usually someone with a license, attorney, CPA, investment advisor, would vouch for them and say, yes, I know them to be accredited, or I've reviewed their financials within the last 90 days and they are accredited. Then they would be able to invest with you. So that's 506C. There is another rule that I think is going to become more and more important shortly, and it's called regulation crowdfunding. So regulation crowdfunding, the tricky part here is finding a registered investment portal that will house your offering, because you're not able to do it yourself. If you want to use that regulation crowdfunding exemption, what it allows you to do is to raise money from private investors, and currently they can invest up to $2,000 without you having any knowledge of their financial condition. So anybody can invest that. If they want to invest more, then you'd have to ask them some questions about what is your net worth or what is your net income, and they would have to meet some additional qualifications for that, but then they would be able to invest more. But as I said before, all these definitions are currently being reevaluated. And Congress just met on a proposed bill to make some changes to some of these rules, and we'll just have to see how it's going to play out.
But one of the big things that you bring to the table, you and your organization, is that if someone says, okay, I'm really interested in doing this and raising funds, you can provide this roadmap, right, on how to do it, the documentation, the process, basically to do it right up front, to CYA, so you're protected on the back end, and that you might be walking through a minefield, but you've got a map and you lead them through, and then it's no big deal, right, when you're on the other side. But it seems to me this is not something you want to try to tackle on your own or DIY, because there's just so many landmines.
No, you don't want to do it yourself. And we see people that, try to get a hold of somebody else's offering package and think, oh, I can just go in and change it for my own.
Yeah.
We've helped a lot of those people, or tried to help a lot of those people correct their deals after they've improperly structured them, or used the completely inappropriate document, or didn't even understand they were selling securities, so didn't provide a disclosure document. And sometimes that means you have to liquidate the asset and you have to start over. But in
Oof.
all cases, it means you have to confess to your investors that you did it wrong.
Hmm.
The problem with securities laws is there's no statute of limitations until the violation is discovered. So once they've determined that there's a violation, which could be 5 or 6 years into a deal, that they have a year to complain about it. So the best thing you can do at that point is say, "Hey, I realized that when we did this in the beginning, we didn't do it correctly, and if any of you want out, you need to let us know, and then maybe you have to liquidate the asset to do that, or you have to re-syndicate it correctly and bring in investors that would want to stay in. Some of your people won't care; they're going to want to stay in. Some of the people will, you may bring in new people to cash out those that don't want to be in anymore. So it becomes a little bit of an ordeal, to do that. But once you admitted, hey, we screwed up on these technical issues. If the deal's going well, nobody wants out. If the deal's not going well, everybody wants out, and then it's an issue, right? And they could even force you to
Yeah.
rescind the offering, meaning you got to pay everybody back within 30 days, and that can be very hard if you're invested in a commercial property.
And generally speaking, if the deal's not going well and then they force you to liquidate, that's even worse, right? So the advice here is to do it right from the beginning if this is the road you want to travel, right? Because it's just so
Yeah, and
much
you want to
easier.
sleep at night.
Yeah.
You don't want to wake up in a panic in the middle of the night because you realize you did something wrong, or it could come back
Yeah.
and bite you. That's, you really want to take the time to learn these rules and document your compliance, and make sure that everyone on your team understands the rules.
Well, and beyond that, beyond just, sleeping at night because you followed the legal guidelines, just from an ethical, moral standpoint, I mean, if you're going to be investing other people's money, I mean, the we don't need another Bernie Madoff out there, right? We need people that you have fiduciary responsibility to people. Some of them, I mean, they are okay. Yes, there's some protections being accredited or sophisticated, but still, this is someone's hard-earned money that you're going to invest, and and they're only investing it because they believe in you and the investment, and they expect a profit and a return. And for you to do it sort of halfway is not a very responsible approach to that. Might be how you handle your own finances, but not someone else's, right? And so
Yes.
so to me, if you're going to do it, you need to do it right. And that way, again, you're sleeping at night, and everyone understands what they're getting into and investing into. Things, we all understand that things happen that we can't control, but to your point of disclosing up front, these are the potentialities that we are aware of today. We don't know about the boulder striking the planet, in 2 years or whatever. We have no control over that, but you know, um, it's important to do it, and people will appreciate that, because people want to deal with people with such a fake world today. People want to deal with people that are real, and they're honest, and they are authentic, and they're trustworthy, and so just being upfront with people, I think will serve you well. Um, one last question before we wrap up and get into specifically how people can get in touch with you, Kim, and what you guys offer. You've mentioned mentors and coaches a couple times on, getting in the space and learning the space. And, you know, everybody's a prophet, right? Just put a website up and stand up and, beat your chest. Where would someone go if they're looking for a legitimate coach or legitimate mentor that, they're going to get value and they're going to be treated right? And I don't know if you could name drop or some sources that maybe people could go to.
Yeah, I do a lot of teaching for a few of the bigger coaches. So the ones that seem to be most successful at teaching people how to syndicate, and then become clients of our firm, which means they are successfully syndicating, and especially if they come back again and do it again and again.
Right.
Um, the RE Mentor, so it's like real estate mentor, rementor.com.
Hmm.
They have a multiple. So these most of these coaches are multifamily coaches,
Hmm.
but RE Mentor has live events. They have one that's called Family Millions, and they hold it all around the country multiple times per month. Highly recommend that, because that's where you start to learn what is a viable property. What
Mm.
what should we avoid? What can we buy? What kind of metrics does it have to have before it's going to make sense for us to do it with investors? And it's going to help focus your efforts on the right track. So multifamily millions, and then they have another one that's called a private money event, and that's the one I co-teach. So that's a 3-day event that I co-teach with another seasoned syndicator who's raised lots and lots of money, and he's invested before in commercial properties, multifamily, and now RV parks. So RE Mentor is a good group. They have an excellent coaching program. Also, Jake and Gino are a really good group, and they too have an excellent coaching program. And they've got their suite of a lot of these guys will have kind of a more intense. They'll have a big event once a year
Mhm.
that's just a big networking event, and they'll do some teaching there. But then they'll have these kind of smaller groups like a finance right boot camp and a buy right boot camp, and where they're teaching you different aspects. So the idea is you want to walk away with where you feel like you've got an associate's degree
Mhm.
in this particular type of investment. And then also Joe Fairless, they have a really good program. They've got an event coming up. And then another one of our clients, the one that syndicated 26 properties, Vinny Chopra. Vinny Chopra has a coaching program, and he and I are actually teaching an event on April 27th. It's on Eventbrite. So if you go to Eventbrite and you type in Learn to Syndicate, you'll find our event. It's just one day. He's going to be teaching the kind of the practical aspects of finding the properties, and I'm going to be teaching the deal structures, securities compliance, and mistakes people make, and how to avoid them. So that would be a good kind of a well-rounded, learn what you can in a day. Um,
Mhm.
that's a good choice. But there's some other real estate trainers out there. I don't know all of them. Also, Stacy and Jen Conkey, Konkey. They have an event called WowCon, but they also have some other events. So, what I think they're really good at that maybe some of the others aren't as good at is helping people get started with some smaller multifamily.
Mm.
And that's an also all often an overlooked asset, because and it can be somewhat lucrative, even more lucrative than jumping into a 100-unit apartment complex. Conkey, Conkey, look them up. They have an excellent little training program that I think works well. And so with this, regulation crowdfunding, I just met a guy just recently called Ridge Crowdfunding, and they are going to be allowing people to put their offerings onto their crowdfunding portal. And the portal itself has to be licensed by FINRA or the SEC. FINRA is kind of a quasi regulatory agency for securities. So they're legit, and they have to house your offering there. But you also still need us to help you set up the corporate structure and to give you the form CF, which is or form C, which is your disclosure document, and to set up the operating agreements for your companies, the management and the syndicate itself, and then also your subscription agreement. And then there's filings that have to be done with the SEC and with the state securities agencies. So that's the part we help with, and then they house the offering, and they may at some point even be able to help push that out to their group of potential investors.
Hmm.
But you can certainly drive your own investors to that portal. So
Right.
that one's going to be, I think, becoming more important. There's some again some proposed changes in those rules that would make it even more advantageous. With each of them, there's limitations. So you just have to learn the rules. And once we
Mhm.
learn the rules and understand what those rules mean, then they can do that. We actually have a weekly mastermind that we hold for our clients, and that is conducted by a securities attorney. And our goal is not to teach you how to buy the real estate, but to teach you how to develop those defensible relationships with investors, how to get that database of pre-vetted investors, how to make sure that they know you well enough that they will invest with you at the time you're ready to go, and how to keep them informed.
Wow, that's excellent. So, in addition to that, so how does someone, just kind of winding now, this has been so much, I mean, really, really awesome, Kim. I've learned a ton. I've been taking notes here the whole time. I'm looking forward to listening back to this. What about, how do we contact you if, like, you have an investor, a budding investor, someone wants to move into syndication, or maybe someone who's been in syndication and they realize maybe they haven't done it the right way and it's time to, fix that, so they have a long-term career in it, not just a short, flash in the pan kind of situation.
So go to our website, syndicationattorneys.com,
Mhm.
and there you will have plenty of opportunities to look around the site. There's over 80 different articles there. They're all 1 to 2 pages on different aspects of syndication. There's a bunch of frequently asked questions. There's also all of our podcasts are housed there as well as other podcasts like this I've been on where we've talked about all different topics. And they can, if you want to schedule an appointment with one of our team there, then we can talk to you about where you're at in the program. We can, we have a very low cost entry program. We call it a pre-syndication agreement, and that's the one that gets you access to the mastermind, so we can start coaching you on, having that ready, willing, and able database. And then also you can get a free book there.
Ah,
This book, if you've never done it before, How to Legally Raise Private Money. There is a free book tab at our website, again, syndicationattorneys.com. This is a very easy read. If you haven't raised money before, you're going to get a question that says, have you raised money before? If you say no, we're going to send you physically this book. So you have to give us your address. If you say yes and you have raised money before, you're going to get this book. This one's more like an encyclopedia. So this is the second version of that book, more like a desktop reference.
right, right. I like how you did that. Yeah, it's like, okay, the primer, whet the appetite, and then now it's time to go deeper because you've read the first one.
And
Well,
this
that's,
one's good step by step. How
yeah.
to do it pretty much all the things we've talked about here. It'll help solidify just some of the topics that we've covered.
That's beautiful. Well, that's awesome. I'm gonna head over there myself and grab a copy. And Kim, this has been awesome. I mean, is there anything else that you'd like to add that we haven't covered today? We talked about a ton.
Well, the other thing you can do is you can text the word syndicate, SYNDICATE, to our phone number, which is 844 syndicate, SYNDIC 8. Also, the actual number is 844-796-3428. If you do that, you can order that book on your phone. And we just love to. What we do is periodically we do what we call a roundup, and we'll take all the people that have gotten the books, and then we'll offer you to come to a webinar, or give you a call and say, hey, how can we help you?
Mhm.
Where are you at right now? What do we think would be beneficial for you to do next steps? Help you strategize how to get that process going, because it is a process and it is a
Right.
learning curve, and you are getting an education, and there's going to be some time span in between. One thing I don't recommend is, don't just go get a deal and think the investors will come. I've seen people who've advocated that, and I've seen
Yeah.
people lose money on that scenario. It's not, it's just not a workable scenario. You've got to develop those relationships, tell people what you're doing, get that all going, and keep growing that list, and then you're going to be successful as a syndicator long term.
Wow, that makes total sense. Total sense.
Mm-hmm.
And I love the way that you have a graduated approach for people to kind of bring them onto the highway and to learn and get them up to speed, because people need that. I mean, it's, as you said, there's a lot to learn, but it's infinitely learnable and infinitely doable if you just take the right approach and do it over time.
That's right. That's right.
Awesome. Well, Kim, thank you so much for being on the show. This has been amazing.
Thank you, Paul. Yeah, I really enjoyed it.
Hey, gang, just winding down here today. Thanks for listening to the show. And as always, if you need capital to grow your business, you're looking to purchase commercial real estate, or build a building, or invest in commercial real estate, or you're looking to acquire a business, or a competitor, or just need growth capital, we'd love to talk to you. We fund businesses all day long. Our mission is to help entrepreneurs win and to fund their businesses and fund their dreams so that they can make an impact in their community. Reach out to me today. Go to our website, click the button to schedule a 20-minute conversation, discovery call. We'll have a quick conversation, see if there's a need, see if there's a fit, and we can take it from there. The website is VPC, Victor Paul Charlie .capital. That's vpc.capital. All right, there's no .com on that. It's vpc.capital. As always, keep crushing it and hope to see you soon around here. Take care.